Hello everybody, Luke Gromen, FFTT. Hope you're well and had a great weekend. I know it was a beautiful weekend here in lovely Cleveland, Ohio. Getting to be one of the best times of the year with summer and summer baseball starting this week. So looking forward to it all. So with that, let me jump in. Thank you as always for joining me. First question is from R. How should average Joe who's invested in a 60-40 portfolio prepare for what's coming in the next 10 to 15 years? I think it's really critical to understand or just put in context some of what I call the big gears in macro. Understand that we're in what appears to be a bursting global sovereign debt bubble. Also understand that we're in a peak cheap energy regime where you have a secular rise in marginal energy costs, marginal oil costs in particular. And to me, I think if you factor those two things in, what that implies is it means longer duration bonds are in essence a bet that on an energy productivity miracle as it relates to peak cheap energy, for example. So in a peak cheap energy environment, owning longer duration bonds is essentially a bet that an energy productivity miracle will be invented and commercialized in time to offset the secularly inflationary outcomes from not just peak cheap energy, but also the global sovereign debt bubble, as the productivity miracle would help make that sovereign debt repayable in real terms as opposed to via central bank printing. So setting that aside, if we don't get an energy productivity miracle, I think it's important to understand that you're likely to, those two factors together means we're likely going to be in an environment that is highly inflationary over time with high sustained volatility. And so for the average Joe, in my opinion, that means understand that trying to trade that is likely going to be very difficult, best case. And so it suggests for the average Joe, keep your leverage low. Look for longer term secular opportunities. For the average Joe, they have the luxury of looking out several years. Many people on Wall Street, many investors don't have the luxury of looking for alpha 12 months out, 24 months out, 36 months out. So look for longer term secular opportunities. One that I've been talking a lot about that I'm familiar with is, for example, selling into electrical infrastructure. Companies and industries selling into a build out of electrical infrastructure in the United States. I think that's got a long runway to it. Does it mean it's going to go up in the next 3 months? I don't know. Does it mean it's going to go up in the next 2 years, 5 years? I like my odds there. And importantly, I can't necessarily compete as an average Joe with somebody who's trying to trade minute to minute, hour to hour, month to month, but I can compete if I can be patient with my capital and wait 2 years, 5 years in a way that they can't. So that's another way I would encourage average Joe to look at it. And then finally, unless that energy productivity miracle happens, it means I think you need to take a percentage of what you have in bonds, and the 40% in bonds in the classic 60-40 portfolio, and put some into gold, put some into gold miners, put some into commodities, put a little bit into Bitcoin as your inflation hedges. And so I think that's how I would answer that for an average Joe in a 60-40 portfolio. From Stephen, I've seen tweets stating that AI is becoming good at investing. Could next black swan be AI identifying that the entire global debt-backed economy is nothing but a dumpster fire, recommending to buy things like gold, silver, and Bitcoin, which might unleash an insane rush? It's an interesting thought, and I don't laugh at the question. I laugh at the phrasing a dumpster fire because it's, you're not wrong. So it's possible, I suppose. I've looked at AI more from the side of being a turbocharger, if you will, of deflationary forces, technology, which are fundamentally incompatible with the debt-backed system we have, which needs exponential growth and inflation to keep the debt nominally money good. And so for me, the acceleration of AI, to me, will accelerate and pull forward the print or default choice from the world's central banks. So whether it's humans who reach that decision or whether it's machines that reach that decision, AI that reaches that decision, in my opinion, doesn't matter a whole lot. It gets you to the same spot. So to be clear, I would not be putting all my money in gold, all my money in Bitcoin, things like that. I do think it speaks to being overweight physical gold and some Bitcoin. And that's not hard to do, particularly if you're an American, because the average weighting is pretty close to zero for most Americans. So next question from Costas. Hi Luke, great trade earnings report this week. Thank you very much. Can you comment on why high-tech UFO materials would land exclusively in the USA? Is it not possible other nations are also studying the same materials and accelerating their own domestic technologies just as the US claims it's doing? I think it's a great question. I don't know. It's one of these topics that I'm watching the UFO, or I guess that's UAP is what they call them now, with great interest, because to the extent they represent an energy productivity miracle, they could be a game changer. And so it's important to keep one eye on it, so to speak. There's a number of possible explanations, I suppose. Number one is that we're fudging the data. We're fudging about it. We're exaggerating or lying about it. Possible, but I just don't know. Another explanation is that they are weapons, propulsions, energy systems that we have or have built up. However we arrived at the technology that we have it, we're testing it, and it's highly classified, and so these pilots are seeing this stuff at night, but they're only seeing it over the U.S. because it's not going over anybody else's airspace to make sure that nobody else gets a look at it, which makes some sense. I mean, we've been spending $800 to $900 billion a year for a number of years in defense. It's a lot of money. So, it's not like, when you see these stories about the $1,000 wrenches that the Pentagon buys, it's usually, my view on that, it's not a $1,000 wrench, it's a $5 wrench and $955 of different investments elsewhere. So the third possibility, to your point, Costas, is, hey, yeah, others do have some of this type of technology and they're just not advertising it or it's not being detected. Those are, I think, the three possibilities. But like I said, for me, the reason I'm keeping one eye on this and have been for the last 12, 18 months is just understanding that through my lens of the world, how I'm seeing the world, how I'm seeing the data and the context, a game changer would be an energy productivity miracle. And these represent a potential for that. So that's why we keep an eye on it. From SG, do you think the U.S. will be seeking to return to something like the pre-1971 system, or do you think they will turn to something else like a modern Bancor scheme? I think the way the system is evolving is to more of a modern Bancor scheme. I don't think gold is going to be pegged to any currency. I think gold is, at least in the intermediate term, going to serve as a neutral reserve asset for particularly commodity-related deficits, energy-related deficits that float in all, and then gold floats in price in all currencies. So that is Bancor-like, and that's where I think the system is evolving to. From 8745, it seems the narrative is shifting to raising rates raises inflation, and we are entering an election year, where the political creature Jay Powell may feel some pressure. So what happens if the Fed cuts rates in half in 1Q or 2Q24? How many of the current problems go away? In my view, very few of the problems go away. They just change shape. So right now we're having government funded or government driven inflation. So deficits as a result of rising rates, and we're seeing bank problems. And if they slashed rates in half in the first half of next year, then I think you go back to more sort of classic private sector driven inflation. I think that then translates into bond market concerns. The long end would probably sell off, possibly meaningfully, which then has some broader implications. As the inflation, I think, would pick up on rate cuts, money flocking out of bonds into stocks and commodities, etc. So, like I said, I don't know that you fix anything. I think you just move the troubles around. You sort of stick your finger in the dike in one area and a new hole pops out. And ultimately, the issue is deficits are too big, debt's too big, and you have to inflate that away for a period of time to get rid of that problem. Otherwise, anytime you try to make an adjustment, you're just going to be creating a new problem somewhere else. So, which is exactly what we've seen. In the span of less than 12 months, we went from, oh gosh, inflation to, oh gosh, bank problems. So, that's exactly what I mean. And with some volatility in between, obviously. The bottom line is you need significantly negative real interest rates for a sustained period of time to inflate debt to GDP down to a sustainable percentage from which the Fed can raise rates without breaking something quickly. Or you need that energy productivity miracle that we were talking about before. So with that, I'm going to finish up for tonight. As always, thank you very much for joining me. If you like these updates, check us out at FFTT-LLC.com for more information about what we're up to. Our Tree Rings product, 10 most interesting things, quick synopsis of each, why we find it interesting, whether it's confirming or refuting a way we'd previously been thinking about the world. So everybody have a great rest of your week. Look forward to talking with you soon. Take care, everyone.